We're now going to look at the question of price and the market. The conventional wisdom is that the perfect market will necessarily deliver to the community the best prices for anything which is going to be traded. And this is an important concept and certainly simplifies the whole doings of business, because it means that individual buyers and sellers don't have to worry too much, because market forces will one way or another make sure that they deliver to the community the optimum prices that will keep business going and also supply the community with goods and services at effective prices. However, we need to look a little bit more closely at what the perfect market and the practical market are all about. The first thing that's important to realize or recognize is that the perfect market assumes perfect knowledge, perfect mobility, perfect rationality, and perfect substitution in the marketplace. What do these mean? Perfect knowledge means that every buyer and seller has complete understanding of the products, of each other, and the environment, including the future, so that they can understand the value of a good thing in the market compared to a poor thing. Likewise, mobility means that those people who are participating in the market as buyers or sellers can move in and out of the market quite easily if they want to. They have no particular need to participate either as buyers or sellers at any particular moment. They are mobile to the extent that they can enter the market and leave it without any particular difficulty, and they will enter the market because they see some economic or commercial advantage in participating in the market on this particular occasion rather than not. When we move to rationality, we assume that the buyers and sellers in the market are all like little computers. They are all able to use their perfect knowledge and their perfect mobility to work out whether a particular thing on offer for sale is worth selling or buying. It leaves out the possibility of impulse buying and all of those other things which seem to make the human community very different to the economic community. The fourth major requirement for a perfect market is the opportunity for substitution. This means that if I go to market to buy potatoes, I might find that potatoes are in poor supply or bad quality or something, and so I might buy turnips or rice or wheat or something instead. Applying these requirements for the perfect market to actual markets, we find that each one of these four are significantly and sometimes quite substantially violated. Players in the market, both buyers and sellers, some have very much knowledge about each other or about those people on the other side of the market transaction. Likewise, if I am running a business which produces motor cars, I am basically constrained to continue to run my business because I have a tremendous investment in the manufacture of motor cars. I can't simply decide not to buy one or not to produce one on the drop of a hat. Likewise, if I move into a city, say Rockhampton or Melbourne, in pursuit of employment or some other opportunities for my family, I really don't have the mobility to ignore my need for real estate in that particular city. I can't live in Sydney when my job is in Lithgow or something. In practice, therefore, mobility is often limited. Rationality, likewise, fails to recognise the way that very often humans make decisions which are not particularly rational, and in fact much of our advertising is designed to take our purchase decisions away from what might be rationally sustainable. And lastly, when we look at substitution, it comes back to the kind of questions we're looking at with mobility. If I need a house to live in Sydney, I can't buy one in Melbourne, so I can't easily substitute. And real estate, one way or another, is to a certain extent limited in space, and so I can't substitute very easily, even though I might be able to substitute in a particular street or a particular suburb. What is certainly true is that in the marketplace, the real marketplace, there are forces which constrain the various players to behave in some way in a predictable manner. And so if I try to sell something, whether it's shoes or mobile phone, but the marketplace is filled with competitors who will sell at a particular price, I won't be able to sell for a significantly higher price. I am forced by the market to either charge a price which is comparable to my competitors, or I'll simply go out of business. Likewise, it's futile going into a shop to buy a motor car and offer half the price that all of the motor cars in that particular city are being sold for, of a particular quality. And so I'm forced by the market into some kind of behavioural outcome. Let's look at the way that actual markets operate compared to the perfect market. I'm going to take the example of some new innovation. If I dream up some new piece of technology, I might be the only person building this thing, and so supply is quite limited, and so I'm showing that as a very limited supply line, and I'm only able to produce a small number, and I'm going to be inclined to charge a high price for it because it's a novelty and perhaps people find it a desirable novelty. The opportunity to sell it is still going to exist because there will be a number of people who will pay a high price for that small number of desirable goods. What this means is that the market will clear, which is a fancy way of saying that all of the products that I bring to market will sell, so long as I sell at this intersection point between my supply curve and the demand curve. Now, while I actually sell all of the products that I produce, this does not mean that I have a perfect market, and this is a common misunderstanding, that the fact that supply and demand intersect does not mean a perfect market. In fact, in the real world, usually it means an imperfect market with an imperfect price. The sign or the indication that there is an imperfect price is that I'll be earning a very high level of profit, a level of profit which is considerably above that which is needed to be able to provide me with a reasonable return for my capital investment, for my risks, and my investment in research and development, as well as being able to cover my regular costs. This cost that takes into account all of these things, the real apparent costs of raw materials and labour, the research and development overhead costs, the costs of risks, and a return applicable to my capital investment is called the normal cost of production. The price that I'm able to charge above the cost of production is the imperfect price in this case, and it gives me this difference which is known as economic rent. The larger the economic rent, the more extreme my profits, and the more imperfect the market. However, if the market is relatively open and there's a amount of knowledge, the very fact that I'm earning all of this economic rent will become known to my competitors and the market in general. Let's look at what happens with price. Over a period of time, it will induce new supply, which will cause the price to fall as new suppliers come in willing to charge prices which are lower than the price that I started off with. Likewise, the purchasers will become wiser and will demand lower prices in order to buy the stock which is available. And so these two processes will tend to make the market move into lower and lower prices, ultimately getting down to a perfect price. And the perfect price is where the price equals the normal cost of production. This means that all of those people producing in the market at a particular time are able to earn sufficient income to be able to pay for their costs and their risks and their capital investments. In other words, their businesses are able to hum along quite happily. However, if they charged a lower price, then their businesses would start to shrivel up. That's the perfect price. The perfect price has the capacity to be able to maintain businesses quite comfortably, makes it worthwhile for those businesses to continue stably and profitably, but it also delivers to the community simultaneously the lowest prices sustainably available. And so the perfect price has many, many economic advantages. And that is the price which comes in a perfect market. Now, when we apply this theory or these insights to the question of land, we come up with a very curious fact. We've seen here that in a perfect market, price equals the normal cost of production, and this is very, very important. We have to ask ourselves, what is the cost of production of land? We can look at the cost of production of houses and factories and shops and so on. But when we do, we see that that's in terms of building materials and labour. When we look at land, we find that we have simply inherited the stuff from a previous generation. Australia is pretty much the same size today as it was when Captain Cook took all of the continent for the British Crown about 200 or so years ago. It has no cost of production. We're simply shuffling it from one owner to another. What does this mean for the question of perfect price? Well, the answer is fairly simple, and that is that if we have a zero normal cost of production, we cannot have a price for land. Now, the fact that most markets have the land component of the real estate, the property, as the major part, suggests that the price we see in the market today for real estate, or specifically for the land component of real estate, has nothing to do with a perfect market. Land value is entirely due to market imperfection. Adam Smith recognised this about 200 and almost 50 years ago, when he said that the land market behaves for all intents and purposes like a monopoly. And even though there are many owners making it look like something apart from a monopoly, the fact that land price is entirely due to market failure or market imperfection means that ultimately there is no difference between a monopoly and the land market. This as often comes as a surprise to new property economists. However, you'll find that the better you understand this principle, the better you'll understand the whole behaviour of property markets. The last question we have, or rather the next question we have, is that if land is due to market imperfection, then where does the price of land come from? We'll have to wait until next week to solve that puzzle.